When the going is good, you also must understand that things can change. Preparing for the change is very critical. What kind of preparation you need to do? Are you positioned correctly for the emerging scenario? Do you need to do something specific? To understand these things, do join us on this webinar and participate in it to prepare yourself better for your tomorrow in investing. Thank you very much. Friends, in this video for ithought Advisor, I am going to talk to you on the topic when macros play villain. It's not often that several macro indicators turn adverse. We have seen one or more indicators always pose a problem, but when several indicators turn against the market, it's very difficult for the stock market to sustain itself at very high levels. We are heading towards a phase where more than one macro is becoming a problem and several macros may become a problem one after another. You know that it's a chain effect. When you have one macro which becomes uncontrollable, it then starts to tell on another macro and then on another macro, and then the chain or ripple effect plays out. We know this happens all the time when we are least prepared for it. I remember that when the macros slipped very fast, as an investor it was very difficult to respond as quickly as I would have liked to. But once an event has happened, you know that the damage is done, you know what further damage control is needed, and you know what you can do in the circumstances. So as an investor, rapid change in macro is something we need to deal with, and we need to deal with that change in a way in which we turn that event into an opportunity for our investing. Professional investing demands this, but it's never easy to convince your investors to do the right thing, especially when they see that the macro is not favorable. Investors are always willing to do more than they ought to and to go the extra mile when macros are favorable. But the key thing for an investor to do is to do the same thing when they know the macros are not exactly favorable and that they will take some time to come back to a better place. So slippage in the macro is an opportunity. Looking back at my own personal experience in the last decade, the highest returns I made was from the investing I did post the slippage in 2012-13 in macros. You saw interest rates run up very fast, you saw the exchange rate struggle at a very low level, and you saw that investors were not willing to keep their money in India. That was the time when multiple macros failed, and the investing which we did subsequently over the next 2-3 years turned out to be the best investing I have done in a very long time. So macro slipping is not something that we need to be mortally scared of, it is not something that we need to completely avoid, it is not something that we need to dread. We must prepare ourselves for that phase, we must keep our portfolio in the right place for such an event, and when the event happens we need to do things which will deliver way superior returns from that place. Now you may ask the question, what about my existing investments which are sitting there at the time of the event? The answer lies in what would you have done otherwise. If you would not have had better options, then you have to continue in that asset class in parts of the equity universe which are relatively safe, and that is something where I believe that our investors are reasonably well positioned. They are positioned for a trade where inflation hurts. So we are not exactly in a place where if inflation goes up our portfolio will be adversely affected. On the contrary, our clients will actually benefit if inflation spikes up. On the contrary, when it spikes up, it gives them an opportunity to bet in the other direction. which means that you need to build positions which will give you returns when inflation once again comes under control. So, this is an approach which you need to keep on adapting to the context, and you need to always anticipate the next event on the macro front, and your portfolio must prepare for that, so that in every circumstance you are reasonably positioned to at least not be affected much and to then benefit subsequently. So, these are the priorities which every investor needs to understand, especially before the macros turn villain. It is fairly evident now that the macros will turn villain for investing in equities across the world. So, knowing that and acknowledging it is the first thing, preparing for that is the second thing, making sure that when the event happens you have already decided that you will act sensibly is the next thing, and ensuring that you act well in time is our duty. It is what we need to do for our own financial growth and well-being. So, the macros will turn villain. It is up to you to do the right things which will later look heroic. Thank you for watching this video.